Welcome back, gentlemen. I have, as I said before, a little Christmas before Christmas with having you three on the channel. And we are about to follow up what we've discussed also a few months back. We had some really, I think, entertaining, dynamic or heated conversations, especially between Francis and Henrik. We can revive this in a more structured way this time as well. So it's a pleasure to have you guys. And my first question would be, what are, let's say, the most important events that happened in the last 3 months that you would say is paramount? Henrik, what do you think?
That is the role of the economy, no, without a doubt. So it's that we have now an economy that is clearly deteriorating, that we have a business cycle where if the Fed apparently thought that we were in a great economy. We're starting in March and April, and we was hearing how the Fed was talking, and Powell was talking about it. There's this great, strong economy, and the labor market was so strong. Then along came August, and we saw then everything evaporate, and apparently now we are creating around, I don't trust these last non-farm payrolls numbers, but even if you take September, October, they were 119, and then it was minus 105. I mean, that's not how it works. But anyway, I think it's kind of trying to equaling things out, or trying to hide something. Let's put it like that. But definitely it is that the economy is slowing. I'll try just to very quickly here, just to see if I can share my screen and then just show, because it is so clear that I honestly do not understand what you need 400 PhD economists at the Fed at. When you have the non-farm payrolls like this, and we see that we have a 12-month average going here, we see that when we are now at the levels that we are, and we're talking about a level here, there's 90 to 100,000 on the monthly average, 12-month average. Well, that's been a time where we have been closing in on the recession, or in the recession at some point. And this is, by the way, at an economy that is now, at least compared to the financial crisis, is 20 million people more in the labor force than we were in 2007. And yet we are now with this kind of non-farm payrolls. And the same picture goes on if we look to ADP. Is the same thing. We are heading into, and we have a situation where everybody has been talking about inflation. I mean, there's no inflation. I mean, yes, it can be that they have kind of, again, it's been hiding something. That's what I try to say, hiding something here on the inflation numbers, the real inflation numbers. But the thing is, when the economy rolls over, you will see that inflation comes down strongly, and the Fed will start to react to that. And they'll be late. And this time we've been talking so much about inflation, even though it is price level and not inflation that is the problem at this point. And now the Fed is overly hawkish, and we are heading right into a slowdown at a time where the Fed is still overly hawkish. And I think that is really the big problem here. We have a Fed that is completely behind the curve and doesn't understand that this is what you see. So we have a rollover of the economy, which is by far the most important. The thing is only now, how long will it be before we see the blow off top? And we were meeting in February there, and I said we will see much higher levels. We are now getting close to that. I still think you can see 8,000 on the S&P. And Bitcoin, maybe even 150,000. I know that's rather controversial, but that's going to be the dynamics into the last phase here, because now the Fed is coming in. Now we see it, and they have just introduced what they now again call non-QE, and we know what that is like. They call it something new this time. Is it RMP or RPM? I keep forgetting. So, but this is the new QE, obviously, and it's open-ended, and it's going to. They will intensify this more and more as we see the economy slowing, and it's definitely slow, and that's going to be a recession. And I say March, latest April, then you have recession, which, by the way, will not be recognized before 9-12 months later by the NBER.
Yeah, listen, I have the same views on the recession, but I've been arguing since 2022 that we've been in a recession. We just changed the definition of it mid-stride. We changed the goalposts. So certainly it's on my mind. We can get into the details on that. But in terms of the last 3 months, for me, I've been looking at the breakdowns in the repo markets, the COMEX, and, even this QE language we'll get into in more detail. So I think the real story behind the last 3 months is the same story we've had in the last 3 years, the last 5 years, 6 years. It's just culminating. And it's boring, but it's really important. The bond market to me is everything. Credit and debt is everything. It's the rotten wind beneath the wings of our so-called capitalism and exceptionalism for the last years. It's the critical grease in our engines, and it's frankly drying up. That's the key for me. And we're seeing that from the repo markets to the Fed, from private credit markets and shadow banking to commercial banking, from Joe Sixpack to Jerome Powell. And without this grease, everything seizes up. So I think liquidity is going to come. We've got this non-QE Q in December. It's clearly going to be here structurally longer than just a few months, I think. There won't be time, in my opinion, for a last dance, Henrik. We'll talk about that. I don't think this is 2008. I think the jig is up, as we saw in 2020 and as we saw in April of this year in 2025. I think after 40 years, from 1980 to 2020, of an artificial bond bull market, we are entering a natural bear market in the bond markets, the sovereign bond markets. The yields will rise, and synthetic dollar destroying liquidity is going to come in waves. That's what I see for 2026. I just see the grease drying up, the liquidity drying up, and the cracks are everywhere. They started in the repo markets in 2019. We saw them in 2020, saw them in the banking crisis of 2023. We saw it in Liberation Day of 2025. We're running out of that rotten wind, of that grease, and we're going to need to find it somewhere, and that's going to come from a mouse clicker at a central bank near you. That's going to me, have a negative impact on the DXY coming into 2026. It's going to continue to be a tailwind for precious metals, which won't go up in a straight line. But I just see the culmination of all these things. I think the credit market is everything. It's boring, but it's not that hard. It's not that boring. Debt is everything, and debt was the story of our so-called success, and we're hitting a wall in debt, and I can't wait to get into the details on that.
Francis?
Yes. So your question was, what is the biggest thing that's moved on since we last spoke? And for me, it's all been about the fact that we're in a debt-based collapse, and that interest rates go significantly higher. We were the first to call a turn in the debt market and a rates increase expectation in 2020 on the US markets. In 2021, we rolled our opinions when all the Japanese rates were in the sub 1. They were 0.79 on the 30-year. We said these are all going to break out to much major highs. Now everybody's a big spotter on the Japanese 30-year rate and the 40-year and the 20-year. And now you actually have the 10-year above 2% just tonight, which was part and parcel of driving the precious metals markets. So our position has always been rates higher, debt down, and this is the turbo juice for precious metals. So you've seen the yen gap up on rates on the Sunday session, and you've had an absolute surge in gold, silver, and platinum. I would add also that I don't think the stock market's the most interesting thing. Henrik referenced February. In fact, we are down in gold ounce terms. The core advice I gave then, and I continue to remind people today, is that in February, when we last spoke, is you've got to be precious metals aggressive, and that there'll be a turning in the gold-silver ratio, and that a key level is 65, and we're at that level right now. I'll just remind people of that chart share on the stock market. I don't think the stock market is the most important thing. We are moved into an epoch where the biggest story is the preservation of capital, and the preservation of capital means you are aggressively long silver, platinum, and and gold ounces, as well as potentially miners if you can get your certificates. This chart is showing you two things. It's showing you the NASDAQ divided by gold ounces. You can see when we spoke this year in February, you were here, you were in the right shoulder, essentially, of a inverted head and shoulder in an adjustment downwards, I say, in gold ounces, which should be your new basis of accounts. My primary hypothesis is that you do not have a valid basis of account anymore in any fiat. The debasement in fiat and debt is in the Ernest Hemingway absolute escalation to the downside. The convexity is steep now. And as a result, any form of measure of wealth, earnings, or anything can only be meaningful on the big time frames in gold ounces. So your stock market is underperformed. Everything is underperformed. By the way, here's where Brent Johnson was telling us the silver guys are losing their head about crossing $25 again. That was a squeeze primer in a 30-year macro upside HVF, and that's what it's done since. So he literally called the moment, as we were calling the direct opposite, that silver was about to go into a melt up. And since then, we're seeing the gold-silver ratio drop. It was as high in COVID at 126. I would even say to some gold guys, if you're 50-50 gold-silver, for example, or maybe have some small amounts of platinum, you can roll some of that gold ounces now into silver ounces to further maximize what I personally assess will be a single-digit run on the gold-silver ratio. So it's still early days. If you look at the SPY divided by gold, if you look at miners, this is still really early days. We've been warning you all this was going to happen. We've said the primary emphasis is foundational money capital preservation, not the stock market, not anything else. Your wealth increases the most by being in miners, and by the way, the facts have now shown that for the year since January, you're at about 156% on GDX. You're over 100% with both silver and platinum, and gold is having another stellar year probably made 70%. I'd have to check that now with the recent price action, but likely to have done so by the end of the year in my personal view. So I'd leave that as my opening statement.
Great. Well, first of all, I would like to maybe focus on Fed policy and the dollar. The Fed has lowered interest rates recently. Today we are, by the way, Monday, the 22nd of December, just to put a bit of context for viewers and listeners here. What do you expect in terms of dollar strength? So, Henrik, you've been saying last time especially that you would expect a DXY to be at around 120, 122 in this deflationary dollar bust. How do you see that demand then on the demand side? Where would it come from if it's not coming from the BRICS, China, and other allies who are actually net sellers of treasuries? Wait. You were muted. Sorry, Henrik.
Okay, sorry about that. So I think we're looking at this now we are in an environment where this is difficult to understand and to see. If you look at it in an environment where you see a stock market topping out and you see that you're going to see the S&P going into a massive top and then starting to decline, and you see a 2008 kind of phenomenon, which is what I expect. You see a deflationary bust. Then you cannot sit and look at it and say, what is it that drives it today? Because the drivers and the whole environment is going to change dramatically. And I think that right now you still have a risk on. You still have a risk on environment. S&P and the NASDAQ and so on have been moving up and moving higher. And I think you're going to see also crypto coming into this last phase here. You're going to see it moving up quite strongly and outperforming everything. So it will be very much a risk on at this point. The problem will be that when we start to see when the top comes in and when the economy is really rolling over, which could be by, as I said, April or something like that, you will probably see that dollar will start to come out as the cleanest shirt. The problem is not that it is a nice shirt. We don't really like it. The problem is that the only one that is really out there compared to other currencies. And the thing is that if you see defaults coming out and you see a recession, you will need dollars. You don't need gold or silver or Bitcoin or NASDAQ or whatever futures to close those to handle that debt or whatever it is, those bankruptcies and whatever comes out. That will need to be filled by dollars. And that's the problem, because then you'll start to see that feedback loop setting in. So I've said all along also, I see 95, 96 on the dollar. We're not there yet. We are in the final phases. And if you look at the dollar right now, you will see that the dollar is actually starting to strengthen. And you're starting to strengthen in terms of my momentum. And I think you're going to see one last move into, let's say, January, February as the latest. And then you're going to see the Dixie starting to move up. First, it'll not be felt like something, and then it will be felt like everything. And everything means that the Dixie is going to be the only thing that counts going into late 26. It's going to be crushing everything, commodities, gold, silver, Bitcoin will be absolutely annihilated. I mean, I've talked a lot about that, and I will absolutely not be anywhere near Bitcoin at that point. I think people are simply not looking at this in the right manner. That it's going to be the escape valve, so to speak, because everything needs to go through the dollar because the majority of the debt in the world is in US dollars. And that's why. So it will be a self-reinforcing thing going on because of that triggering effect from that recession that I think is going to start in a very near future. And you had the same kind of thing setting up in 2008. Until the Fed finally stepped in and tried to weaken the dollar also at that point. So it's going to be a dollar year. It's going to be a Dixie year, most of it.
And so what are the effects then? Sorry, Matt, I think you're on mute as well.
Am I on mute?
Yeah.
Choice.
Yeah, I muted you because just to avoid background noise.
Sorry. No, I got to respect Henrik for saying his opinion strongly. I'm not sure. I think Francis and I are going to disagree on that, and we could be wrong, and I respect that. There's a lot I've been reading about Henrik, and we've talked about this in South Africa, and I've been listening a lot to Brett Johnson. I've debated with him openly, too. What I'll say, just drawing a line in the sand is, and again, could be wrong, but I think it's a very different world than 2008 as a case study. I think it's a very different world for the dollar than what we're projecting. And I respect the strong dollar case. I mean, you talk about 58% of global FX reserves are US dollars. By the way, it was 72% in 2000, so it's already trending down. It's 80% of global trade finance, the US dollars, 13 trillion in global debt denominated. It's got massive euro-dollar demand, SWIFT, 90 trillion in FX swaps are traded. And there's, no doubt if there was a massive deleveraging of the US dollar, that would actually make the dollar go higher. So I get a lot of the strong cases for the strong dollar, and I get the 2008 case study. I think we're missing, again, the fundamental elephant in the room to me is that we're missing the bond market signals. I think the last dance that Henrik is projecting is possible, but if I use the case studies of March of 2020 or even Liberation Day of 2025, in March, bonds and stocks and treasuries tanked together when there was an uh-oh moment. Liberation Day was a major uh-oh moment. There was crickets at the treasury auctions. Bonds were not rising. They were tanking. Yields were spiking. And there wasn't that same love for the dollar or the dollar proxy in the U.S. Treasury. But I think for me, after 40 years of this bull market in credit in U.S. Treasuries, which was artificial because of low rates and QE, I think that the Fed is losing that thermostat control of the bond market. For 40 years, whenever the Fed cut rates, long-term yields fell. That's what it's supposed to do, but I think that's over. And that wasn't over just in November of last year. That was over in 2001 when Prince Bush Jr. was en route to the White House. Greenspan was slashing rates, I think 6 consecutive times, and yields went up. And the DXY did skyrocket. I think it went from 108 to 120. And then late last year, the U.S. was cutting rates, and the DXI went from 100 to 107 in November. But I think investors want more premium for U.S. debt because there's dying faith, not just in the Fed, but in that entire monetary system, including the dollar. And I think as rates rise, QE and a weaker dollar is going to come. There's not going to be time for a last dance. And I think they're going to just have to bring in the fire hoses. And I think that's going to keep the DXY from spiking to the Brent Johnson levels of 130, 150. I don't see the trend going that high. In fact, I see the DXY going down. And again, this is where the big debate is, and this is where we're going to roll up our sleeves. 70% of U.S. Treasuries last year or this year was short-term debt to pay long-term debt. And this was unsustainable. So I think in 2026, we're going to see the U.S. will be a permanent buyer of U.S. debt. Temporary QE will become structural QE. I think the DXY falls. I think SOFR overnight volume breaks new records. I think the Fed balance sheet goes up 500 billion to $1 trillion. And I think the dollar's percentage of global reserves will fall below 50%. Again, now it's at 58%. But again, I think the strong dollar camp talks almost evangelically about this circle of power, like it's a Tolkien novel because of past case studies and the undeniable lack of a U.S. dollar equivalent. It's not going to be the ruble or the yuan or the euro dollar market and the SWIFT and the FX reserves and the derivative man. But I think all those arguments in favor of the strong dollar misses the U.S. Treasury and the bond market because it is the thing. That thing is drying up. We saw signs of that in the repo market in 19. We saw it in March 2020. We saw it in QT when QT started in 2022. 2.4 trillion of QT. It was the worst stock and bond market in nominal terms since 1871. And the repo SOFR volume, the overnight lending liquidity among banks spiked ever since. The system needs constant liquidity every single day. And then, of course, in December of 2025, overnight repo rates completely disconnected from the Fed funds rate. Boring stuff. But the Fed was quietly pumping in $25 billion in liquidity overnight. It bought $12.5 billion worth of distressed bonds. So it's QE back. It's $40 billion a month for now, but I think it's going to get much higher and much longer. And that's how I don't see there's a strong enough case for the dollar based on the need for this artificial fake rotten wing grease liquidity. I don't think there'll be time for a 208 moment. I do think of markets, and they will mean revert unless they're too big to fail, and we literally just print trillions to keep the market as a national security interest. We can get a higher market at the expense of the dollar. But I think, as we saw again in 2020 or even 2025, when things go wrong, the bonds aren't the safe haven. The dollar isn't the safe haven. It doesn't mean the ruble or the real or the rupee or the euro is the safe haven or the yen. It just means that they're going to have to keep this bond market alive. It's the home of the world reserve currency. It's a weaponized, unloved, distrusted world reserve currency. You could argue too big to fail, but the only way to save it is immediate liquidity, not giving it a last dance, but immediate. And of course, they're going to save the bond market at the expense of the currency. And they're going to do that until there's some kind of dysfunctional global reset or an uh-oh moment. Even Brent Johnson said the dollar won't die easily, it'll die violently. I think it will die violently. I think there'll be a lot of trouble, a lot of international geopolitical stress, but there's still going to be a major fire hose from the Fed that will destroy the DXY strong argument, in my opinion. That doesn't mean gold can't retrace temporarily in an uh-oh moment in the U.S. stock market. I agree with Francis. The U.S. stock market, to me, doesn't interest me anymore. There's so many hidden risks in it. It doesn't interest Warren Buffett. Doesn't interest Michael Burry. It doesn't interest a lot of the smart clients at the family offices that I talk to. And I agree it's at a frothy blow off top. But I think when it does have an uh-oh moment, if it does have an uh-oh moment, I do believe in Bob Farrell's mean reversion, that when it does, the Fed will be in there immediately to prevent the DXY from spiking. The U.S. can't afford a stronger dollar. And whether you like the U.S. or not, or like the dollar or not, they're going to save the bond market at the expense of the currency. And I think that's, again, the ultimate tailwind for precious metals. And if and when things go wrong, rather than rush to the lifeboat of that last sacred, relatively stronger sacred cow U.S. 10-year or U.S. dollar, I think investors are going to move to the better store of value, the new strategic reserve asset, the new tier 1 asset by the BS. They're going to move to gold and silver, or gold in particular. They've already been doing that pre-crisis. When we have another crisis, I think that's going to be the seismic change. Again, that's my theory. We're clearly drawing a line. It doesn't mean that gold can't pull back in a market moment or an up moment or a margin call moment. It doesn't mean there won't be a retracement in the gold price. But secularly, I never look at the gold price. It's just going to continue to have highs. It will always have retracements, certainly in a market uh-oh moment. But I don't think 2008 is the case study anymore. I think the world has changed so dramatically between 2008 and today, in particular with regard to fiat money, particularly with regard to precious metals and gold in particular. And I think the world's already signaling that that's the better strategic reserve asset, the better store of value than the U.S. 10-year or the U.S. dollar. And when we do have that uh-oh moment, we're going to really see where it goes. But the last two uh-oh moments that I looked at in 2020 or even in April this year, the U.S. Treasury wasn't the life raft that everyone was going to. It's not the life raft that central banks are going to. As of now, they hold more gold than U.S. Treasury. It's the first time since 1997 that central banks have more gold than U.S. Treasuries. And look, they've been tripling their purchases since we weaponized the freaking U.S. dollar and U.S. Treasury in 2020 for that, or 2022 for that avoidable, shameless war in the Ukraine. So the system is broken, the dollar's broken, and I think they're gonna solve it the way they always do, with more liquidity, until we have some kind of dysfunctional, horrifying reset, which will involve even the IMF, so it's going to revolve some kind of gold coverage. Whether you like central bank digital currency or not, it's going to have gold in it to have any credibility. So I just think the entire role of gold is changed. And I'm not looking at Keltner bands or Bollinger bands. I'm not a trader. I'm a wealth preservation guy. I'm a former bond stock guy who just sees the system as rigged. And it's all about preservation now. I don't think wealth's going to be measured in fiat toilet paper anymore. I think it's going to be measured in ounces and grams. And I really do, strongly disagree with the strong DXY case. I could be proven wrong, but since I debated Brent Johnson this 2 or 3 years ago, the DXY has consistently gotten weaker, not stronger. So at least for the last few years, I've been, I think, correct in that assumption. The real test will be when we have the proverbial shice hitting the fan in the next market drawdown, major mean reversion moment. Where will the money go? Again, it's not going to go to the ruble or the yuan or the peso or even the yen, but it doesn't mean it's going to go to the dollar either. And that's going to be the real test, where I could be right or wrong. But even if I'm wrong and gold has a retracement, I'm not going to try and pick from what price gold will be when that retracement comes. I'm not going to miss out on the chance to buy it now and try and time the price. I just want to have it, because I hold gold for 10, 20, 30, 40, 50 years generationally. I've been doing it for the last 10 years that way. Never look at the price. But I'm not a trader, and I'm not looking to trade it. I just want to have it because I think the rest of the world does too. That's why we're seeing massive outflows from the COMEX. That's why we're seeing the dysfunction of the central banks. And I think we should talk about the LBMA markets and the COMEX markets. They're another huge signal of what the world really wants. And that's the question. Will the world really want paper currency in the next crisis, the relatively strongest horse in the glue factory, or will it want a precious metal? And I think that's the key distinction where we're going to have this debate. And again, I respect the debate. I respect the argument. I certainly respect Henrik and Brent Johnson, brilliant arguments. I just think we're going to really test this thesis in this debate when we see the proverbial, hitting the fan whenever and however these markets mean revert. And there's plenty of reasons why they're going to mean revert. And that's a whole other conversation.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. Francis, where do you think the DXY is going in 2026?
On balance of probabilities, I would say, by the way, it's not long run. Certainly, we're very one-sided. It's a debasement of the currency. America is the most dirtiest shirt of them all. So I disagree with Matt and with Henrik in terms of this trope of cleanest shirt in the laundry. It's by far the dirtiest and largest shirt in the laundry. This is proven by stats. If you go on the number, everybody thinks Japan is the most indebted first world nation. When you add in unfunded liabilities, Japan goes from about 253% to around 350%. When you add in unfunded liabilities to America, and I've done this with all the G7 nations, from all the worst, the Western coordinated, the whole leper colony of lepers. And the winner by a million miles is America at between 550 and 600% debt to GDP, even though it's on a registered 130, 135, because they've chosen to cheat. And this is a big theme that I think most people are missing. You need to be early on trend. We were calling Henrik's confidence now in the recession when it originally qualified as a recession long ago. And we said the cheat that you are facing here is the labor numbers, and that those will be grossly restated. And you will see that, in fact, even when Biden was in charge, that when you met the criteria for a recession, it was in fact a recession. And this claim of a red hot labor economy turned out to be government hires, DEI hires, and consultancy hires. You have to be ahead. We've been seeing that recession for a long time. We're preparing already for the next cycle, which is another point of difference with Henrik, is that actually inflation is now the story for those that prepare a cycle ahead. You actually have a Fed head that is cutting rates in an environment that you've averaged 4% over the last 5 years on a target that used to be 1 became 2% and is as very close to 3% in the short term right now. You're cutting rates and returning to a not QE. So everything tells you in preparation for the next part, you're going to get deflation part next. So we've already delivered on the stag, and our model is a hyper stagflation. We continue to explain this to everybody, that you're getting an extreme version of typical stagflation. This means, in general, it is a major impoverishment event for most people. Cost of living, checkout at the point of till, all these costs are going up. By the way, as a quick screen share, just a quick few commodities that are unrelated to gold and silver. We have for you a beef chart. Where is it? Let's go over here. Whoops, there we go. Coffee. beef chart, that's what's happening on meat. If I pull up the coffee chart, you'll see what Robusta and
Francis,
Arabica beans.
we only see your Twitter
I apologize.
frame.
Let me make sure I'm sharing the full screen. It goes full screen. It sometimes wants to just do browsers. So that's the beef chart, for example. And this is through many, many different assets that you can see soft commodities. And this is fiat debasement trade. This is the debasement trade. This is what's happening. Everyday consumables are going up. I've got anecdotes as well. People that put the exact same Walmart checkout list items that they bought in 2020, and it's 2.35 times today. So all the anecdotes are there that you are the fiat part of the debasement is immense. Your question was about the Dixie. And overall, longer term, we say it's lower, but we've got to remember it's also being measured against the Dixie is inherently a measure of lepers to lepers. America is the dirtiest shirt, in my opinion, and you're going to break that red trend line on balance of probabilities is my assessment here. But if I was to be wrong, it's not the most highest conviction thing that I'm discussing and talking about. You could quite possibly pop through the 100 and churn a while longer and break a little later in the year. But you are coiling here. This is a monthly Dixie chart, by the way, trapped between the 100, which every time you run, you get pulled back under, and this basing ascending grind line, which represents a trend literally from subprime. So I think you're going to see during 2026, our big predictions of 2026 are 6 major nations through the 6% range, which is the 5.75 to 6% on their long end debts, which will be continuation of the themes we've continued to assert, which is why you entered into a key epoch in 2020. And this is debt debasement. And on that, I'm pretty aligned. Matthew and I have similar views. So I expect rates continuing to climb. By the way, we'll show you the Japanese yen pop for not the yen, my apologies, the 10-year, 20-year, and 30-year pop that occurred Sunday. So you've got a runaway from that was in many instances sub-zero right the way through the range that is now 2s, 3s, 4s, heading for 4s, 3.8% on the 30-year. So what you're going to have is there's a squeeze potentially, and this isn't being spoken enough about, especially for the dollar bulls who think we're about to have a ripping run in the dollar while we're doing QE and cutting rates, and Japan is raising rates. Let me just highlight, to have a running rip in the dollar is certainly contrary to everything we're seeing. While the debt was coming in, the US 10-year actually started to go up as rates were being cut. And that's a warning because the 10-year is the shortest of the long end. And it's a real warning to the Federal Reserve that they could have their Bank of England moment, that people will start to realize the central banks don't actually control rates apart from the short end, and eventually they can lose that too. You have real continuation structure. You've come down. And in fact, while they were talking about this cut, you actually have a reversal structure here, technically. With a nice W bottom here, and you having a little dip, and I would imagine rates are going to continue to the upside. It's going to become an incredibly hard sell. We've exposed the scale of the Cayman Islands mega buy-a-thon that is being facilitated by the primary dealers, Bank of America, and the likes of JP Morgan, who are actually doing 24-hour repo funding so that Cayman Islands can be holders of a 1.8 trillion, let me just say that again, with a T, 1.8 trillion portfolio position. And these are hedge funds, not the nation state, which are very meant to be speculator vehicles in debt. And this is being facilitated and only allowed, and I see it as part of the great lie, the phony support for the American Treasury market. The biggest buyers is the United, outside of Caymans, of course. By the way, just on the Caymans, to give you proportionality, they have a 7.3 billion economy. So it's like this is the proportionality, earning 250K a year and having a 68% 68 million bond portfolio. So if you had a gross salary of 250K, you had your expenses and all your excesses, how likely is it that you would have just in bonds alone a 68 million debt portfolio? Well, as I've explained, it's hedge funds, it's speculative vehicle, and they are being facilitated to do this. And I see this all as an orchestration of larger forces of dark state. People think the CIA doesn't extend into financial and other things. They've been funding all forms of things for ages. They are propping up the debt market. And when the rates climb, which I expect they will, the long way that means is fiat and debt debasement. So certainly, without overly putting too strong an opinion on the short term, dollar down for us, certainly on the medium long term. And it isn't the cleanest shirt, it will go down. And if you continue to get the squeeze that the Japanese rates are forcing, all borrowings that were made in yen and went to Casino America for return may have to reverse once the costs of the interest rates. The only thing that's been saving the carry trade is the yen has been outpacing the dollar in debasement now. But as the interest rates continue to correct and close much closer, by the way, there was another important chart. Japanese inflation for the first time crossed higher than American inflation. That should be a warning signal that rates are going to continue to outperform in Japan. So their debt debasement on their official debt will be accelerating further. And that's going to mean they'll put up rates higher, which could eventually lead to a hard reversal in the yen. At the moment, we are long the dollar yen just as a fund and a hedge trade for our gold for those rare dollar strength moments, which are very, very few between. But this is really back to main theme. We're in hyperstagflation. Prices are going up. And the people that are smart will recognize cost of living is going to go up immensely. The only preservation is that you are in gold ounces. It's the only thing that is going to keep your nose ahead of the prices of beef, coffee, and many other grains. So overall, my answer is dollar down.
Very
Henrik.
good.
Poor Henrik. So
Uh,
that's two on you. What's Henrik's response to all this? Because I don't want to leave him out of this because he's
I
got a
want to
lot
ask
of.
what happened. I mean, there was many things. I mean, let's jump on to one thing first. We say QE is going to be negative the dollar. What happened in 2008? And I don't agree with you, Matthew, that we cannot see similarities to what we had in 2008. Actually, I think the similarities are quite striking. But only that we are now in a new inflationary scenario. I said that a long time also. We are a new inflationary regime. The whole thing that happened during COVID was, in fact, a inverted Volcker moment. We went out, we saw stimulus into a situation where the supply chain actually broke down, and we're going to see prices going higher. The problem is people are now chasing yesterday's news. And this is what we're seeing right now. We're seeing people talking about inflation as it's something that is here right now. I think there is a difference between the long and the short term. And then coming to what the dollar is going to do, because I agree with you, longer term, 100% agree. And I think still, however, that the dollar is and will be also for a considerable long future, the cleanest shirt in the, amongst the rest of them. The thing is, when we start to see QE, and we saw that in 2008, for instance, what happened to the dollar there? We saw QE. What happened there? We saw the dollar actually rising a lot and strengthening from the moment they introduced QE from around 71 on the Dixie, and it rose within a very short time frame to 89. That was if you took on the time base wise, it was 8 months, and it rose by 25%. Why? Because you started to see that deflationary part that we were going into in 2008. So I think you are, honestly, to say you're right, but you're early. The thing is, we're not at that stage right now where we have stagflation. First of all, we don't have stagflation when the inflation rate is at 2.7% or 3% for that matter. Stagflation is 5, 6, 7, 8% at a time when the non-farm payrolls are in the negative or very low. I think you're too early. And that's the thing. I agree with you. Down the road, we're going to see exactly that. We're going to see that unfold. But the problem right now is we cannot simply see that the market will just continue up from here, because there's so much risk already, happening out there. And that you have a deflationary bust like what you saw in 2008 when the markets were too frothy, and you have the rollover of the business cycle like what we see right now as well. It's not something they can just print themselves out of as we think. So I think you're going to see exactly what I said. The deflationary development is going to be very, very bullish on the dollar. And I can just say that the 120 on the DIX is what I see, and it's going to be a reversal to the 2001 top. In that time frame, you're going to see a lot of downside on commodities. But going after that, which means we are 9-12 months apart, I think it's going to be absolutely right. We're going to see all of those things. Nothing moves in a straight line. Not gold, not the inflation level, and so on and so forth. And I am with you. Have a new trend. But if you look at the trend, it's not going to be just in one line and one direction. So I say that people are misunderstanding that when the Fed steps in, it's actually a sign that at least also people think that the Fed now has everything under control and they're going to see that the U.S. now will be standing for longer. But because remember, it's still a relative gain with the rest of the world. The euro is 57.4% of the Dixie basket. I think the yen dollar is at 11% or 12% or something. So you have all these. And if you look to those, by the way, all of these are in decline, but look like they can make a massive move. For instance, the dollar versus the Swiss franc, which is also part of the basket, is looking extremely bullish after the next move that we have lower. So I just have to say, this is a timing thing. I think you're going to see the strong dollar coming in, and you're going to be absolutely squeezed in everything that is hard asset at this point, which, by the way, I see also in a new bullish setup, but there is always pullbacks, and the pullbacks can be quite severe. And this is what I'm saying. So deflation, but then stagflation at a later stage, and that's where the dollar really is going to crash.
Well,
I saw Francis head.
I got to say a couple of things. I'll let Francis kick in, but I mean, again, I'm not trying to do a gotcha. This is a debate. No one here has all the answers. We have probabilities. I would disagree on a couple of points on the stagflation. Again, you're quoting CPI scale, which I've always said is it's like as fake as a 42nd Street Rolex. The inflation scale that we use to measure CPI from the Bureau of Labor Statistics just gets a Nobel Prize for fiction. It's at least double digits inflation right now. So you're already in a high inflation environment. If you trust the BLS, we're not. But I don't trust the BLS. I take the L out of the BLS, and that's the CPI scale. So you're looking at negative real rates across the entire yield curve, from short end to the long end. You're getting, 70 bips more for holding a U.S. Treasury for 30 years as opposed to, 4 years or 5. It's a joke. And I think the evidence right now, we get into the recessionary evidence right now in a separate silo, but there is no doubt from my time in the U.S. just last month and from looking at the data, especially when the BLS was canceled for a couple of months because of a shutdown. When you looked at the private measurements of U.S. economy, U.S. employment, U.S. Stress levels on Main Street, from car repossessions, credit card delinquencies, year-over-year unemployment, year-over-year layoffs, seasonal hiring, the evidence from the private sector outside of the BLS was so much more honest and so much more devastating that we're actually in a high inflation, low economic standard right now in the U.S. So that to me is stagflation now. You will have deflationary forces, but we're going to have the mother of all inflationary reactions down the road. But we're already, to me, in stagflation. And employment, again, if you look at the numbers, that's a separate conversation, but I think we're looking at Nick Eberstadt or other guys, Eugene Ludwig, who I look at, we're probably at 25% unemployment in America. And that sounds sensational. But again, that's the delta between the official BLS statistics in the DC corridor and the reality of a private and I think Main Street citizens feel. So I think we're in stagflation. I think we have very bad employment already. I also think that, in terms of what I'm seeing in terms of the dollar and the DXY, I don't want to get into a huge kind of wonky discussion on COMEX and LBMA, but there are massive signals there that this is very different than '08. And again, just my disagreement. I mean, since I've been in the markets, and so he says November of 2024, but I mean, the COMEX is never, my whole career, the COMEX was a net exporter. Now it's a net importer. But as soon as they get the gold in the COMEX, it's leaving the COMEX. And for decades, less than 1% of COMEX gold stood for delivery. This summer, I saw 100% standing for delivery. In other words, 20,000 K standing for delivery. The LBMA's free flow last December was 0. It was T plus 60 days. In other words, there's no gold in that market. Why? It's not just a COMEX wonky anomaly in the COMEX. What it is a signal. It's an absolute signal that the world, sovereign wealth funds, sovereign nations, And bigger players outside of the speculators and the shadow bankers and the hedge funds, they want their physical gold. Again, because they're already preparing. They're loading their bullets before the army crosses the river. They're loading their ammunition before the dollar tanks. They're getting their gold now. And the COMEX is just one extreme example of that. And the LBMA silver market, again, started there in 1987. It's the world's primary market for daily price discovery. It's a private market. It's got contracts governed by British common law. But, you know, it's got a supply problem. In October this year, the LBMA market in London literally seized up. It had 700 million ounces in its vault, of which 650 million ounces were for ETFs. So there was no free-floating available silver. There was another 140 million ounces were not even offered for liquidity. And I don't say this to just throw out numbers, but they needed another 50 million ounces injected. And they blamed that on worker or truck shortages or the weight of silver. It was harder to transport. Again, it's a T+1 exchange. It was T+8 weeks. And today, standing contracts, promissory notes for silver are at a rate of 700 million an ounce. There's only 50 million ounces for actual delivery. So in other words, what I'm saying is the LBMA is tapped out. It's a first in, first out, cash and carry exchange. In my entire career, when I was trading commodities and trading bonds before I figured out precious metals, the lease rate in the cash markets for silver was 2%. Now it's above 5%. So the entire free float of global silver is 36.8 billion. That's a very, very tight supply. So my question is, which billion bank will be the first to do the run? It's like that Kevin Spacey movie during the 2008 crisis, which was the first hedge fund to dump their MBS and go long CDS and ruin their reputation, but save their butts. It's going to be the same with what party's going to make the run on the LBMA or the COMEX markets, because they're literally out of the precious metals. And what that signals to me, without getting into all the math and all the wonky futures contracts, and what just happened in the silver market this December on the 12th, they tried to raise the margin cost to short the silver price, and it didn't work. What we're seeing in the dysfunction at the COMEX and the LBMA is a world that has already seen the uselessness of that dirty shirt, best shirt, worst shirt, laundry. It's almost irrelevant because it's just a bad shirt, period. Fiat money is a bad set of shirts. The US dollar on a relative basis we can debate. It's a rotten shirt too. But the point is, it's a fiat money crisis. The world reserve currency, the weaponized, distrusted, unloved, disgusting world reserve currency, post-2022 in particular, just isn't going to be the safe haven, neither will be the 10-year or the 20-year, the 30-year, or the 2-year. Because I think the world's already catching on, and we're seeing that in the COMEX and the LBA, these nuanced little exchanges in London and New York that no one's supposed to follow or understand. It's just starting to make headlines on platforms like this. But what that's saying to me is these smarter, not necessarily better, more moral players, but the smarter players, the nuanced players, are taking their metals off because that is going to be the strategic asset in the next moment. It's not going to be the dollar. And I think, again, that's what we'll see in the next crisis. But using 2008 as a comparison, because of all the things that have changed since 2008, I think is a false comparison. Could be wrong. But what we've seen in the COMEX, what we've seen in the outflows, what we've seen in the LBA, I have never seen in my career, including 2008. So it's a very, it's not this time is different. It's actually, nothing's changed since throughout history, from 250 AD to 1990s Yugoslavia to Weimar. It's just a bad paper system. It's dying. Gold and silver aren't pet rocks anymore. They're strategic stores of value. They're strategic reserve assets. And I think that's going to be the test. Where will the world go? The informed world go? The retail world? I'm not sure. Where will they go when things go wrong? I think we're already seeing that everyone sees that these markets are tapped out. They're over-levered, and they're supported by fiat money that has no faith and confidence or trust, which is extremely hard, as John Rubino says, to quantify or qualify or measure. That trust is dying at every level. And so again, from those things I see in the COMEX, even with the petrodollar, look, we've been trying to get Maduro out. The U.S. is not freedom-loving and democracy. We're trying to do regime change. We're trying to do sanctions. And now you're going down, we see Besant going to China, begging for China to buy U.S. treasuries. And we're seeing waivers for Exxon to drill oil out of Venezuela, because we've been bullying Venezuela for years, but now we need some of that heavy crude because our refineries can't use the Texas oil that's light crude. So in other words, from the petrodollar to the COMEX to central banks to the BIS, all the signals to me post-2008 make it a very different world in the next crisis. Whether it's in 2026 or tomorrow is really irrelevant to me. It's so inevitably on the horizon that whenever that crisis comes, I don't think it's going to be the same world. I think the signals we're seeing from even the BIS, from even the LBMA and the COMEX markets, which most people aren't supposed to follow, are very dark on the dollar. And again, it's and I also think the stagflation that you think we're mistiming is already here. And I think we could talk about the U.S. versus Europe, or the recession and the non-recession. I think the U.S. has been deep in a recession for 3 years. We lie about the recession just as much as we lied about temporary inflation. We lied about the independent Fed. We lied about the recession. And as you know, I think that was Charles Goodhart. When you politicize data, it's almost always a lie. And as, what was it, Jean-Paul Juncker, the president of the European Commission, what do we do when the data is bad? We lie. I think the trust in the data, like the trust in just about everything else that comes out of it, the Brussels or DC think tanks, is not there anymore, because their data, and this maybe sounds sensational, to me is fiction. And it's just, you know, you lie to keep time buying. You lie to buy time. You lie to do the tricks from the Caymans to Brussels to the Fed to the Eccles building. But I think we feel that lie in Stevensville, Michigan, or Toledo, Ohio, or Cleveland, or Speyer, Germany. We don't feel that in Monaco or Palm Beach or LA. And it just depends on who you ask and what data you believe. But I think we're in stagflation. I think the world's moving away from the dollar. And I think we're going to see an inflationary reaction to the stagflation that we're already in. I do believe that deflation and inflation run in cycles. And we can certainly have deflationary moments like a market mean reversion or a recession or even an unofficial recession. But I think we're already in one. And to your point, when the NBER tells us we're in a recession, it's like it's like a doctor telling you're sick when you're already in the morgue. It's way too late. Which is why I think it's really important for investors not to wait for a pullback. And I'm not saying that as a gold executive. I think it's very misleading to wait for a pullback when you don't know a pullback from what price. Because when we met in South Africa in February, with gold's at 2,800, and if we're talking about 38% or a 30% retrenchment, and you wanted to wait for gold to go on sale, well, now gold at 4,200, if you went on a 30% retrenchment now, it'd still be higher than what it was when we were there in South Africa. So it's trying to pick that window to time, I think, is very dangerous. I think it's misleading to people that want to protect themselves from this openly dying, melting ice cube, which is fiat money in general, the US dollar in particular. I'm not saying that as a gold executive. If you're going to hold gold for 10 or 15 or 20 years, I don't think it will matter in the long run whether you bought it 4,200 or 2,800. Of course, I would have rather bought it 300 or 1,600. I'm not trying to be flippant about that. But you're comparing a precious metal to an ice cube. And in terms of its store of value, I just worry that some of these messages are going to get confusing to people. But if you're thinking 20 years out, 30 years out, and I do think gold's going to be at multiples of a higher price level, I think we all agree on that. But I think the timing of the stagflation is already past. I think we're in it, certainly in the US. I can say that from my personal experience and my personal bias of the distrust of the BLS and DC. And I think the timing of the DXY is somewhat muted because we're already seeing the world moving away from the dollar. Why would it suddenly go into it when things get even worse than they are now without massive mechanizations? And I think you're going to see support from more than just the Fed to keep that bond market alive, despite the fact that it's rotten to the core. So again, unfair, maybe we're teaming up on you, but it could be wrong. Maybe there will be a life raft move to the 10-year and a life raft move to the US dollar in the next moment. But I think the signals that the world's already moving away from that dollar. And I think that's going to be, again, the key divergence point when we see it tested in real time. Right now, we're speculating.
Let's put it like this. 110 on the Dixie. If we go above that next year, I'm right. If not, you're right.
I've always said the range for the Dixie was 90 to 110. I think it's 90 to 110. Because you had Brent Johnson talking about a 150 Dixie or 130 Dixie.
Talk us cheap, gentlemen.
I don't. 110 isn't to me enough. That I can see it in that range. I mean, Gunlach sees it in that range too.
But 110 would not be kind on anything.
No.
So that's
if the Dixie's at 110, where would the yield in the 10-year be then? You know, again, it's like, where would the yield in the 10-year?
I think again we're talking about here. I disagree also with the direction of yields. I mean, again, we're looking. If you look to the short end of the yields of the bond curve, you'll see that the short-term yields are actually moving down quite strongly. Look at the 1 month, look at the one year, and they lead 2, 5, and so on and so forth. So what you're seeing is actually the opposite of what you're sitting here and saying that the yields will be going up. I think you're going to see, as we always do into recessions, you see that the short-term yields will start to decline a lot. Are we going to see all-time lows on the yields? No, I don't think we are. I think we have seen a bottom in that, and that's the difference. I see that there's a pullback in the yields that we see, and I think there's a pullback in in gold, and I think you're going to see the dollar topping out in that process. So I agree with you on a larger perspective. I just think we're talking about that you think, the two of you think that we're here now, and I'm saying we're not here yet now. We are here because we have an inflation narrative that that be going on, and everybody's saying, yeah, the inflation is here. But actually, it's not, because if you look to oil, if you look to nat gas, now also putting in maybe a larger high that I think a larger top. If you look to rent inflation and so on, it's not rising; it's declining quite a lot. So this to talk about the water coming into the to the top is increasing here. That is simply incorrect. And we're seeing normally when you have a labor market, deteriorating like what we see now, that's when you start to see the yield. I don't care if the BLS numbers are correct or not. I mean, I'm with you. They could be very wrong. But the thing is, there's a slowing of inflation right now. And the question will be, what will happen if a recession sets in? I say there's a short time period, and we're not talking long, 3, 6, 9 months, where you're going to see a rather steep decline in inflation. And again, the numbers, the inflation levels are, from the BLS side, lower than we saw into any other other recession. And this time it's actually going to be much worse. I think it's going to be a full-blown balance sheet recession. In that environment, you want to be long the dollar. You don't want to be long something you can't close your loans with, or whatever kind of debt you have. So that's just what I'm saying. I think we're agreeing in the bigger picture. I think it's just early. And that, I think, is really summing it up. Because to me, that first of all, there is one last dance, and it's going to be quite strong. And you're actually starting to see the first legs of it here in the Santa rally, as I think is going on. And then you're going to see that the whole thing will shift. And I think as I said, also, you're going to have a situation where the risk on for some time can outperform, gold. So meaning Bitcoin can take out gold, and the Bitcoin gold ratio can actually rise quite strongly. I just think it's early. And that's the only thing, because down the road, I'm with you. The whole situation is where fiat money is dying, and you're going to see also the whole debt problem is going to resurface here. And I actually think that the whole situation here can become into something of a sovereign debt crisis for more countries.
Well, listen, I want to respect that, because look, I think the DXY could go to 110. I don't think it's going to go to 130, 150, and certainly not for 6 to 9 months. Could be wrong. And I also agree that gold can certainly have even in the middle of a bull cycle, have a major retracement, whether it's market induced or not, whether it's S&P induced or not. I mean, literally from 1971 to 1980, when gold went from $35 to over $800, in 1975, midway through that bull run, it had a major shellacking moment. In the middle of that run, I think it lost 50% in a year, 25% year over year. So it was a major pullback in gold in the middle of its bull market. So
and that's what I'm talking about.
Yeah.
And that's the only thing I'm talking about here.
Okay.
I'm actually talking exactly about that,
Yeah.
because if you look again to the 2008, and this time I think the crisis, the deflationary bust is going to be bigger. It was a 35% decline from the March of 2008 to September 2008. That's what I'm talking about. I'm talking maybe this time it's going to be more like 50% or something.
Right.
Am I bullish gold? As I said all along, it sounds like I'm the one that is not bullish gold. I'm extremely bullish gold, and I'm extremely bullish the precious metals in general and commodity. The commodity cycle that we go into after this next bust, I think is going to be something,
Right.
Yeah, it will be for the history.
We agree on that,
but it's only the timing of it. I think the timing.
Right.
That's the only thing.
We don't know what the price will be from the pullback. So like in 1975, if you've got shaken out of the gold market because you saw that year and that pullback, and you stopped having faith in precious metals for market reasons as opposed to fundamental reasons, you wouldn't know when to get back in. And my concern is that when we talk about pullbacks, of course there's going to be pullbacks in gold. Of course, significant. But from what price point? And I'm afraid that's keeping a lot of people on the sidelines, not because I'm trying to sell them gold and Zurich. 90% of people aren't going to be my clients, 99%. I'm worried about the retail investor who's going to hold off on buying that ounce of gold or silver now, because I think there's going to be a sale price next week or next year. But will it be a sale price from what? From 4,200? From 6,200? From 8,200? I don't know. And because we don't know that, or at least I don't know that, I'm afraid it's going to make people miss out on the chance to look 10, 20 years down the road and just buy their metals while they can afford it. It's bad enough that gold's too high for most people to afford. Silver's still affordable.
But you can make that case for everything. You can also say you could buy Apple stocks then now and say that it's all good, or you can buy Nvidia, because Nvidia is probably going to go up in the long time frame. So you can buy that. You can say that for everything, right? And I'm just saying that the pullback is going to be bigger than I think most will anticipate and expect. Am I bullish? Yes, of course I am, because I'm with you on the whole fundamental part of it. It'll be.
You're just not bullish now. You're not bullish now. You're gonna.
I think it's at its too. I mean, just look at the sentiment also. I mean, the sentiment is now insanely bullish. So that I think that is also a tell sign. It's all about timing. I mean, it's the timing is about when are we going to see this? Are we having stagflation now? No, absolutely not. We don't have stagflation at this point. We have an economy that is slowing, yes, and we have that is very clear. But we also have the signs that this is going to lead to some kind of decline in inflation that we are seeing right now. And I can't sit and say I just distrust everything that we see out there, because if we do that, then it's like, what is it that we're discussing then? By the end of the day, we need to stick to some certain facts, and they're going to say, do we trust them or not? Maybe they are kind of manipulated, and I could definitely see the reason for that. And I do see also for the non-farm payrolls. But the situation is simply when the business cycle rolls over, you have that inflation is coming down, and that's what we're starting to see the first signs of. And you have yields coming down, and that's the only thing I'm saying is we will have all this unfolding at the time when things are starting to pick up again in speed. And right now they are slowing in speed, and that's why I simply think it's a 6-9 months difference in terms of the time window. Because again, I mean, I'm sitting and looking at all the commodity companies that I want to get long into when we see that when we see the deflationary phase, and we see the, like in the Big Short, when Bernanke went into to Congress and all that and had its speech. I mean, we're going to see that same moment where they have to come in and start, stimulating the economy even much more than what they do now. There is going to be a deflationary bust, and that's the point when we get when I say that things can start to unfold. Until then, there is another game which is more risk on, and I still think that if you look relatively at things, and I'm not a Bitcoin guy and I'm not a crypto guy as such, I am into the asset that will perform well, and I see Bitcoin gold is going to do the ratio there is going to do tremendously well over the next weeks to months here. So let's see.
Francis, anything to?
So, some general comments. First of all, I don't. Everyone who gets a chance to meet Henrik or Matt should take it up. They're both lovely people. I attack arguments aggressively, not people. And it should just be addressed to the argument. We had a great time in Cape Town, and I'm sure you will always be treated very well, and they're interesting company. In terms of the markets, I do, however, there's quite a few points where I depart from everybody's views as well. But I would say, in Henrik, the fact that you see that people will model for inflation as a binary thing, light on, light off. It's a non-inflationary environment. We're going to be disinflationary. The biggest chart that shows us my particular take is our call that we made a year ago of long gold, short oil. This shows that, in fact, you are having a debasement period, the gold going up part, and that you are having an economically hard period. It's not that Matthew and I are not acknowledging the recession. We've already called that recession. We're asking what's coming next, and we are saying the second wave of inflation. We're not living retrospectively and still talking about the first wave of inflation. We've already moved from the first wave of inflation to calling the recession quite some time ago, and we're acknowledging the recession is playing out now, but that's the current news. Markets are forward discounting mechanisms that are pricing the next step. So we're already saying, where are we? And when you look at a Fed cutting rates in a above target inflationary environment, and you're seeing this, we put this forward as in February very explicitly as probably the best trade. I think guys can get sucked into arguments that are less beneficial, such as where the Dixie will be. Will it be 100 or 110? To me, that's not the most important thing. I think the dollar down, so I'll throw my all in on that. Henrik mentioned how good the dollar is looking to the Swiss franc. To me, it's not looking good. It's leaning on a broadening structure, and I think you go down from that. So, we have divergence of views, but he's a lovely guy. If I talk about the trade of the year since our February meetup, you're looking at it right there. And I would argue our guidance in February, which was this is a 6-month chart on Twitter, by the way. So we were around here in February of this year. Our guidance was precious metals and gold generally, and silver to outperform. That's your best trade. It's not the NASDAQ. It's not anything else. I don't want to get involved in pig wrestles. The pig always beats you, and you both end up dirty, as there's some to say about what level the Dixie is. Generally, it's going down. Generally, all fiats are going down. I want to focus on the key macro winning point. This was the winning trade. I'm very interested in how do I best serve the people that are watching this and my own community even more so, and myself primarily. You know, the Ayn Rand principle is self-love and serve yourself. So I speak very simply my rules. I don't have to remember what I once said because I'm spinning yarns. I keep it real cut and straight down the line. In February, we said you don't own enough silver. We also said you don't own enough gold. Right now, you're sitting on probably 125% by the time this year is ended in terms of the silver trade. That's an alpha tick. The NASDAQ, the Dixie level relative to other crappy leper currencies, those are small argument squibbles that I just don't care to wade too deep in unless I have a technical setup that is specifically giving me a tradable event. I just know the general macro move for all fiats in terms of gold ounces, and that's down. And in silver, even more so now that it has triggered this particular pattern that we're showing you. So I would like to congratulate everyone here, because I don't think even Henrik disagreed in giving one of the best calls in February to everybody watching this. If you did what you heard here on the Gold Republic channel, you are smiling. And you didn't do badly if it was just gold you bought. In fact, I will highlight further, and I'm just interested in how do we give the alpha and what I would say further from this point to people who are watching the channel. So rather than not getting into the weeds of the USD Swiss franc, I just thought I'd put a counterpoint on that. But again, that's getting into pig wrestling territory. I'm staying out of the sty and I want to play and win the main game where we can still stay clean and really make the big banded money. And if I take everyone back on that, if you look at the gold silver ratio, which is something I think these kind of charts are the charts we should be pulling up in front of each other. We've just met and having that bounce I suggested might happen at the 65. We've had this line up on this chart forever and a day. And anybody who watches our channel, the Market Sniper YouTube channel, will know I haven't just put that on here now to sound smart. We've warned that that's going to be a key level and that it's going to surrender. You've been in a holding. In fact, that box goes a little bit further. Normally I do it in my favorite color, the transgender pink. You all know I love a bit of that. And it goes something like this. And we've been in an extended range, 21. You jumped onto this level. We've called it the 75 to 95, and you surrendered brutally the 75, which is a massive shoe to drop. So people who are winning already and with us, I want to give you further alpha to that 125% you got from February. And I would say if you were, for example, a 50-50 gold silver portfolio by value, 80-20, I'd never get rid of every ounce of gold. If you want to move fast and you want a lot of value in your pocket, gold does a lot better than silver for that. But we've suggested you may get a bounce here at the 65, which was a previous key level, a little bit of a bounce. That's probably more gold overperforming than silver hard crashing. Silver can correct a little bit as well. You know, if you're investing, this should not be mission critical. If you want to trade, I would suggest you check us out in terms of HVF method. But of course, I would say that. But this could have a small bounce. But the longer run here is it's going down a lot further and harder. So to someone who had 50 by value, let's say he's at Matthew's services, who I'd certainly recommend, and you've 50-50 allocation, and you got in touch with Matthew or any of us that are in this space, and you pivoted 30% of that 50 of gold into silver and went 80-20 by value, I see much further falls here in the gold silver ratio. I'm going to take this chart up to the monthly point time frame and just highlight this, and I'm going to put it to make sure I've got it in log scale because it's looking a little bit squashed. But this is a beginning of a journey. On the minute you pivot to a monthly, yes, on the weekly or maybe the daily you get a rally, it's going to probably look like one big red candle. The next critical level for us is 32, and that comes from previous interactions over here and downside targets. So this line is double value validated. At that point, you probably have another reaction, and then we've said all along we think you're going to be off the chart and you're going to dip below 10. Can I also just highlight Silver Guru, Dave Morgan, I think it is, was highlighting the amount of silver ounces that are being pulled out for gold. And here's something people should be thinking about. That's gone from like 9.3s, 9.1, 8.7, 8.4, 8.3. You're now at 6 for this last year mining results. I think that's the end of 24 rather than this year. You're at 6.9. So it's even less than the 8. So for me to stand up and say single digits, it sounds like an outright outrageous call to go 9.99, which would represent single digits. And at that point, I would probably use that as my silver rotation back into gold and or other assets, which will be incredibly cheap at that point. You could even make a case. And then equities, general equities, I'm not talking miners. Miners are a unique category that we say you should hold now as well. Other general industries and equities, agriculture, who knows, could be very interesting at that point. I'm not a permanent gold's going to outperform guy. I am not so much a gold belief. I believe in trading the best asset class for the epoch we're in, and we moved into a new epoch in 2020. And that is the precious metals preservation of capital. And the chart I was threatening you with was, I believe it was the gold divided by oil chart. And this is something that might help address the framing that others have similar views like Henrik's, that regarding inflation. And then you can't be inflation. In a recession, you can't be inflationary. We are currently being that because gold is moving up. It is highlighting that fiat and debt debasement is occurring. That's behind that beef price chart, the coffee prices charts, all those softs that are going up. Prices are going up, but wages are lagging. We had a wealth era during Greenspan where everybody became mass affluent and they pumped assets. Now in gold ounces, remember, it's your unit of account. Your housing was going up more. Your .com was the era where stocks hopelessly outperformed gold. But from after that, subprime, you had a rally in stocks. It was actually at a lower level in gold ounces. So we are now in a stagflationary environment where you are stagnating wages. That's the recessionary part that Henrik has got right, that Matthew and I was calling really early and saying, don't trust the labor numbers. We're now saying you don't trust the BLS numbers on the inflation. The inflation is far higher than you're told. But then people say, what do you trust? And that's a point Henrik was raising. And I say, the only thing is the gold price and charts. That's why I'm a list. I see what the rich people are doing. I'm not in the first 1%, but I'm happy to be in the first 5. And I can tell you, oil they don't want the inflation number to get out of control. And the Rockefeller complex that controls oil is making sure there's more than enough oil pumped, despite all these possible wars that might happen. Thing that is a multiplier element in inflation because it's in delivery, it's in packaging, it's in travel, it's in holiday and leisure, it's in absolutely everything, disproportionately low out of intent at a time whilst currency is debasing. The only truth canary in the room is this gold ounce that I keep telling you about. And I can tell you it's murdering oil, just like we said it would. It made this inverse head and shoulder. There's your left shoulder, there's your right, and that's your big old head there. It's made its target. It had 3 pullback months after running its target, as it does, according to our theory. And now the reversal trend is continuing. And what was actually 1 ounce of gold bought you 14 ounce barrels of oil. It now buys you 76, and I'm here to tell you it ain't over. And that is your hyperstagflation. There's not enough demand. Consumers are wrecked. They aren't buying that many new cars. They aren't driving as much. They aren't feeling as pucker. They aren't feeling as awesome. When you feel awesome and rich and wealth, your oil and energy consumption goes up. It's proportional. It's a fact. And what's actually happening is you have a 2-tier economy here. Man in the street, most of us, and we aren't in their sexy club, are generally doing worse. Unless, of course, you bought gold, silver, and platinum and you're laughing and all your accounts are at all-time highs. I'm lucky to be in that camp, and I suspect I'm not the only one. But this here is your hyperstagflation expressed. A crushed consumer, a very well supplied oil market to keep the worst of the inflation number down to a fake number around the 3%, but a runaway gold market. So there's 2 contradictions in there. You can have global dimming and global warming at the same time, and they can both be valid and both be true. And I sometimes think people think too binary in terms of there's inflation, there's no inflation. These forces coexist and they flare up, and the second wave is far worse worse than the first. The first is the warning shot. So I'm here to tell you it's going to get worse before it gets better. That means gold and silver is going to exceed and your expectations in the new year. It's not good generally for most people because they haven't positioned correctly. So you're going to have social unrest. You're going to have the 6x6 nations. So let's just finish our three predictions. 6x6 macro Western nations, which I've included Japan in as well, Australia as well, even though they're not really in the West, but they're part of the Western axis, that are going to run on their long ends, the 5.75 to 6% on their long ends this coming year. That's prediction number one. That is the turbo juice for gold. The debasement of the debt is the rotation trade. I mean, I find it a bit bewildering when people think they've been masters of correlation here and they go, hey, we've checked this whole thing out. And, you know, if gold goes down, let me just try find that particular tweet. Well, here's another one. I seem to have lost it. It seems that, you know, interest rates and interest expense goes very tightly correlated to the gold price. Yeah. Guess what? It's a rotation trade out of one phony reserve asset into the legacy established major asset. This is all you need. You don't need a PhD and all correlation shows this. You're dumping the one for the other. It's a rotation. This is the biggest rotation and it's huge. The debt market is so vast that this trade, call it, it's actually an investment position rather than a trade, is going to have to run for years, and you will have to have very high interest rates, and you will know about a full-blown debt collapse. You will know about crushed governments that can no longer spend what they've committed to in terms of welfare services to their people. They're going to go into tax extraction mode because the original inflation was how they taxed you on the sly. Now they're going to have to come face to face. So far more direct tax threats are coming your way in a tax scavenge mode, which is something we've highlighted. We put stamps out with the, you know, the eagles and the vultures at least eating the carcass. They're going to come for you. There's going to be social unrest, and the masses are going to be pushed into a UBI-based serfdom. And that's where you're being taken. And rather be the rich slave, Matt says he loves that one, you've got to take the right action to ensure you're not part of those that have been pushed into the compliance for your UBI category, because it's going to be a bitter, vile world there. So getting this call right and recognizing it's far larger than you think. Most people are going to sell too soon. I'm here to tell you, you're positioned. You married Giselle Bundchen. Stop looking at all the other bloody girls. You're the winner. Stay there. Be happy. And milk it. That's probably not the best phrase straight after Giselle, but anyway, this is where you should be. Stay exactly where you should be, and maybe rotate to silver to maximize until you run single digits. That, I think, is alpha speak for people watching that, and that's what brings me here. How do I help people do better in these times? Thank you.
We haven't even talked about platinum yet, but maybe it would be better for us not to even mention that or not.
May I ask one thing? If we are here to make sure that people are doing better, or that we are, you know, maximizing our portfolios here, then if we're going to see Bitcoin doing an outperformance here of in the next coming months, we can agree then that we are not in a debt deflationary bust at this point. And we'll also say that it probably would have been good to potentially have some leverage or some position in Bitcoin. And because what I really don't like about this is this becoming so fundamental. It's like it's only gold and silver, and that's the only thing that that matters. What I'm saying is that I'm being flexible on it. Did I see the spike in gold like to this degree? No, I did not. I saw that the stock markets were going to run up higher, and we have seen that. And I've seen also that the DIX is going to decline, which we also have seen. So the situation still sits there. We have a recession coming. We could see the DIX is starting to move up. And as I see it, honestly, when it comes to the Bitcoin gold ratio, again, I can just say Bitcoin has outperformed, not that I'm a Bitcoin guy, Bitcoin has outperformed gold for the last many years. It is not the same as saying a Bitcoin is going to be a safe haven for the long time frame. So we need to say, yes, there are certain periods where certain things will do well. And if I'm then saying, okay, for the next 6 months or the next year here, will gold then be the best place to be, or silver? That's, I think, probably could be the case. I say, no, it's not, because we're coming to an end of it. It may, I don't think DIX is bottoming out right here, but we'll have a little lower, as I said, 95-ish. But then you're going to see the dollar is going to be extremely strong and it's going to hurt it. So I think it's about, if you just go far enough back, you can always say, yeah, this asset has actually done better than the other one. And I just want to, hold on to that and say, hey, if we're looking onto the next 6 months, what are we going to see? Dollar strengthening. Yes, I think that will start within the next couple of months. That will hurt a lot of the risk asset. And the what we'll see as the go-to assets like gold and silver. And I think honestly, also you can see Bitcoin outperforming it for some time. I think the run we have here has been something of a narrative driven. And again, I'm just saying we have I'm probably behind you in terms of the when we see this whole developing, the whole thing developing here.
Matthew, and I think we'll have to conclude after that.
Could I jump in on that one? And just because Matthew's not sharing charts, and then I'll hand back and I'll make it short as well. The best thing when you have an alternate hypothesis, and again, just because this is not a personal attack on Henrik, I love that people offer opposing views. My answer to an opposing view to what I've assessed was always refer to the chart that gave me my original views. I like a simple message for people that are watching. Not everybody here is geeking out on finance and every intricacy of every asset class. B, with metals like silver, so this is the fundamental, then we talk now on the technical, it is also a long-term safe investment. It has always been. With Bitcoin, it has a possible termination point. When CBDCs exist, will they allow Bitcoin to coexist in the same time? Because
I don't think it will.
If a CBDC is going to be restricted in what you can buy and how much meat you can have, why would you want to hold the CBDC? Everyone would buy Bitcoin, so maybe they will finish it. You look at MicroStrategy's Ponzi, I feel that he's built up, and then showing up at JP Morgan's place in terms of, who is he trying to see that his company survives, or is he taking instruction? So I don't feel the same security with Bitcoin. Its origin story never made sense. Everybody accepts the NSA funded the Mag 7 now. There weren't the dorms, anyone that I speak to, the dorms and garages to multi-trillion corporations. Why would you accept the imaginary Japanese friend that disappeared in the ether and never got his award? So all those highly suspect aspects, do I know the absolute answer? I'm not going to pretend I do. Put to one side. Let's look at the technical, which is my main driver. And this macro trend of Bitcoin outperformance to gold has broken down. That is our red line. That is a clear one. A second.
But I mean, this is a little chart. I would say
it's not a little chart. It's since the inception of Bitcoin.
But if you're drawing first of all, you take a chart to go back to 2012, and you draw a line somewhere. I could draw lines also where you can actually see if you draw a line from the let's say the bottom in 2016, that bottom there, right there. Yeah, you were there. Yes, and you go through the 2020 low. Yes, like that. Further. Go on. Yes. There you also had a break lower, which didn't mean that you had a top in price. So I think we can always do these. But that's what I'm saying. That's what I'm saying is that I think you have one more run up. I'm with you that this is going to break down horrendously. But I just think there's one more, because if you go in on a weekly chart now, because this is a multi-month, this is a multi-year. If you go into try go on a weekly.
Yes, we can go on a weekly, but your analysis starts from macro.
But it starts macro, but it also. But I mean, we can always drive draw these lines, and all of a sudden we break down, and that breakdown is the ultimate thing. It just showed that it's not, because it's not. It's just about straight lines. If you go in on a weekly, you will actually see that there is a very nice bull flag signing up on the Bitcoin gold setup. And if that is going to play out, which I think is worth, you have
show me what you're referring to. You said there's a bull flag.
A, B, C. The bull flag is from the top of November 2024.
November 24.
Up right top,
there.
There. And then you have a first leg down. That's an A wave. Then you have a B wave, which is a 3-wave move. And then you have a 5-wave move. So this is the A, B, C that you have right there. And if you look at it there, you actually have from 23, you have a 5-wave move up 1, 2, 3, 4, 5.
You could have and then you have and continue to go down.
But this is exactly. You could have.
There's too much speculation in what you're saying.
Yeah, but then I'll say, Francis, you'll say that you have been moving up since 23. you are up a lot on this chart. So again, it depends on the time frame here. It was saying, what are we talking about? You put out a 10 years chart, 15-year chart is one thing, and I'll agree with you. But if you pull out a shorter time frame, I'll say I disagree with you, because I don't think you're right on your technical there. I think you're looking into right at the bottom of what is a bull flag. And if you look to the daily chart on that Bitcoin gold ratio, you'll actually see that there is a positive divergence, which means that the chart is setting up for a very strong run higher. So I think these lines here is not all there is to macro, and it's not macro just because you pull out a 20 years chart.
What the market price. So we're talking about, we want truth and we don't trust data stats. What people pay in markets, especially as the men with the biggest money move the markets most and are usually the best informed. This is the closest thing first to truth. And the localized highs here are getting ever more marginal. You marginally made a new high here.
We agree.
Now that we are at 2.2, you've spoken, let me finish. Now that we are at 2.2 trillion market cap assets, there is no more vigor to get this degree of acceleration that you had in the early doors. So it tells you money is going elsewhere. And then you see a far larger market cap asset class absolutely running. And you saw silver and gold as we show you. This is a rounding top. This is typical convexity of slowing momentum. You like indicators. If you do a macro momentum indicator on that, you will actually see that. This is, to me, quite patently clear that the best periods of Bitcoin is behind it in its relative valuation to gold. That is a fair and accurate.
But I disagree. I completely disagree with that. I completely disagree. And that, again, is a point I want to make. That was actually my point. And I'll say, okay, now we look 12 months ahead. And we look into the next period here. I'll say in 3 months, this year will go to all-time highs, which will be the final high. And that's that's where this long-term chart here shows like this is imminent. This is going to happen now.
There's no evidence for that. You're just saying we'll go to an all-time high. That doesn't make it true.
That's what I'm saying. No, it doesn't. But that's what I'm saying. Let's see then. Because again, that is about the final risk rally that I think we can see, and where you see the dollar coming down, you see all the liquidity coming in, and you're going to move to a risk on. And you see actually that gold has been outrunning itself, and the narrative about inflation, which has been, whether you say we don't believe the numbers, is still what has been driving this higher to a certain degree, as I see it. It's been people running into something that everybody speaks of. So the sentiment here can change the direction of this quite strongly. And I actually see a strong run up. If you look to the, as I said, on the weekly chart period, if I can see, I can find it. You actually look at something that looks from a very, very bullish in a term of a the bull run. Let me see if I can find it here. Just hang on.
While you find that, let me finish on crypto from our point. There is a crypto. We're not anti an asset category. I have distrust on its origin story, and we are actually long as a community on Monero, for example. So if you really want to have a token in the crypto space, this is a privacy token, and privacy is something that has been completely sacrificed. And this is a draw that technically makes sense for going higher and has gone higher. It started.
But why would you think only one then? Why would you think it will only be Monero? So now you had to think.
I never said only Monero. You've just put in the word only in something I've already said.
But I'm just saying.
We don't choose to be in everything because we like simplicity and we want a certain degree of exposure. I don't want to buy the index of crypto. If I look at the total, it's garbage. If I look at the total 2 and 3, it's not great. We also gave in a YouTube Ada's midnight, and it's also a privacy token, and it's absolutely ripped. This came from real technical assessment. In fact, we streamed this Saturday. So for people that think that we just hate on crypto, let me just show you. That's how it on a 4-hour chart. This is again the privacy theme, and it's trading utilizing real method. That was our method. You got that trade from us, and that's what it's done so far.
What I'm trying to say, it's not about. I think what you're showing here is exactly my point. My point is that you have a run higher in a lot of cryptos, and I think you're pointing out to some of them, and I think you're going to be right. But I think you're going to see that there will be a lot more. And the total crypto market right now, as I see it, can rip to around 7.5 trillion in a situation where you actually see the rotation of gold into Bitcoin.
We've always said they want digital assets. And the
That's why I say,
deflation of the bond world and the fiat world will be an inflation of a new digital world. So as I keep saying,
but
we're
it's
not
again,
telling you these
we're
things
just,
won't go up. We're just telling you Bitcoin right now is not the option because
but
you
I
made a case for Bitcoin.
don't
So we
get the
disagreed on
point where
that.
you have a debt
We
deflation.
provided an alternative, which is actually already moving, and we gave you technicals for which we have stop losses.
Henrik, finish your point, and then we'll move on to Matthew.
I just don't see how we can be in a debt deflation if you are actually, you're pointing out a few of those and they're saying, hey, we are in a big debt deflation and everything is actually going to be really painful here if you look to the risk side.
Deflation is fiat debasement. You're missing the fiat debasement. Everything goes up in fiat debasement.
I get it.
Yeah.
I get it.
Let's hear.
The only thing I'm saying is that you're looking at a few coins here and just saying, well, these are going to do well. Where I actually say, I think it's the whole market that is going to do well. And it's going to be mostly driven by Bitcoin, but mostly by Ethereum at this point. And that's going to crush gold relatively in a short time frame. And you're actually proving my point somewhat because you're showing some of these that these looks great. I can show you others that looks really great as well, and including Ethereum for that matter. And
but
that's
you're
why,
arguing that's why you're saying there won't be a big crypto world.
Let's just Henrik finish. Let Henrik finish, and then you can give.
So I'm saying the run up that you're pointing to there is exactly the run up that I'm talking about, and that's why I am with you that we're going to see this developing. But you're early, and your own charts on a few coins here actually kind of proves it, or at least indicates it.
Okay. Francis, a small answer, and then Matt.
In terms of crypto, we have certain areas, and our expectation is that you're being transitioned from an old legacy fiat banking system into a digital realm. And we've said many times before this exact saying, they've got to deflate a Jupiter and pump that beach ball in the corner up to Jupiter size. This is a transition. And we've said gold is the arch that preserves your capital during a deflationary period whilst getting into the digital period. However, we point out that it's not their intention to make you wealthy. So first they bring about a problem reaction solution, a massive crushing disinflation, so that when the inflation of the other system occurs, this is about firing order. It's a bit like the cylinders in an engine. What's the firing order? You've got to jump from point to point at the right time. They want to crush the masses so that they do not participate in the inflation of the digital system. So understanding the ordering sequence is very important. It's important you preserve your capital and are being in the movers now, and also have half an eye on the fact that this other aspect will be brought up. Right now, Bitcoin technically is not the most interesting, and I actually have called for Bitcoin dominance to fall, and others will come forward. So on some of that, I think Henrik almost agrees with me. And
no,
that's
I do agree. I do agree. Bitcoin dominance is going to crash.
But
100%.
you don't want to be outsized in crypto now because the whole game, unless you
I think you're putting things
into winners, you're going to potentially get crushed if because they aren't finishing off the retail market in cryptos. You've got to be very, very careful now because there's a transition going on. And that's why the bridging assets are the likes of gold and silver that we are putting, and very select trades. So I have a portfolio for crypto and I keep it very ring fenced. And I have a traditional market portfolio. This ensures, in case you get another sell-off of great scale, MicroStrategy gets tested by the sharks who are smelling the blood, and they really sell Bitcoin off.
But if you look to the correlation,
very risky, and
if you look to the correlation. If you look to the correlation between altcoins and your coins as well, and to Bitcoin, if you were to, I'm not a Bitcoin guy. Let me just put that out really clear. And I'm not even saying you would be in Bitcoin compared to the Ethereum or compared to anything else right now. I'm much more out on the risky end of that, I can promise you. So what I'm saying is that you're looking to a full few coins here, and that proves the point. That proves the point that there is another run-up in this risk market here. Because if you have a debt deflationary scenario, you're not going to see something like Monero doing well. And that's the problem here. That's actually the problem.
Your assumption is that
that's the problem with the theory. That's the problem with the theory. That's the problem with the theory where that's the problem with the theory that you cannot say that there will be one or two or three because we have pointed them out and these are going to be great. But in a debt deflationary environment, you're not going to see them do well. And that's where the theory
we could be in a major market crash, and privacy tokens specifically could be doing well, and the rest could be doing badly.
I fail to see that. I fail to see that.
You see, you're too unanimous. Privacy is there to hide people. Where Zelensky, with all the donations in Ukraine, what do you think these guys will be utilizing to move their money around? And it could be the worst disinflationary environment. You could have a stock market crash and all sorts of things. The real money that hold the money is not you or I. These are people that have money regardless of the economic climate. It can be incredibly disinflationary, and they will use a particular token's use case, and you can have the meme. We've already had Zcash run. I've shown you Knight is running, and I've shown you Monero is up. But actually, XRP is looking dull and is at near lows, XLM, a lot of others. So as people start to see the different cryptos more specifically for use case, we had meme coins. The theme was the meme at one point.
But I agree with you. You're talking about a debt deflationary scenario right now.
You're saying all cryptos go down. Or there's no way you can have, they all have to go, they're 100% correlated. When you're in the high risk and you have a stock market crash, as for example, there will be a pressure on them, but select themes that are very dominant.
But this is a debt deflationary scenario, and then you think that Bitcoin is going to crash, but you're going to think that these coins are going to hold up. I just don't see that.
I never said that has to happen. I said it's one of the scenarios that could happen that you've ruled out.
No. I rule this in. I say that you're going to have a risk-on rally. That's exactly what you're proving here with these indications of these very minor.
A risk-off, you can't have anything rally. And I'm trying to point out that you can.
I'm saying in a risk-off rally where the dollar is going to move higher, which I think it will, they're going to see that these are getting crushed, and including Monero, from whatever point it gets to at the end of this cycle. I'm with you. It looks very bullish, the setup you have. But the problem is that will not happen if Bitcoin is crashing from here. That will not happen if you have a debt deflationary scenario. That will happen into a situation where you have a final risk-on rally, and that is going to put in the top of some of these, and then you have the whole thing unfolding. So that is actually proving my case as I see it, but that we can disagree on that.
You've had sectors rally into crashing crypto before. So it's already disproved for me. There's been isolated cases of specific sectors rallying in a downward market. It's not common. I'm the first to concede that.
Not on the crypto
especially
side.
if you're having a dollar-based collapse and you're having people wanting to mask their transfer of wealth. I could very easily see a set of circumstances where privacy coins could be climbing in an environment where
show me any alts that
I'm making the argument of a stock picker and saying it matters which crypto. You're making the argument of, hey, it's going to be a pump, all markets up, all boats on a rising tide.
Yes.
People can choose from that. Selection matters.
But I just want to say, to choose any period where we've seen Bitcoin starting to push, and Bitcoin has been the driver of everything when it comes to crypto. So if you look at Bitcoin and it actually starts to push lower, you will see altcoins also going that direction.
Generally, yes.
I'm with you right now that the Monero chart looks very bullish. I think there's others, a lot of others actually looking very bullish, including Bitcoin for that matter, and Ethereum. And that is actually why you're going to have this risk-on rally that we disagree on, but that's where I say that's going to be the final high.
You might not. But if I show you the F chart, so you're saying you're going to get a risk-on rally. Let's just look at the charts. I always go, that's an opinion. What does the chart say? So if we have a look at ETH-USD, it's not a clear case that you would be in a very good position. If we just go up to a decent time frame, this is Ethereum. I will go maybe 3 days. It's clearly tapped out at 455. And if you look at how we've drawn it up, because we watch it all the time, you will see that we have a broadening structure.
Okay, but again, we can talk about this. I can show you how it looks extremely bullish, and then I'll tell you. Let's again look 6 months down the road. I say 9,000 minimum.
You said Ethereum and Bitcoin are bullish, and I'm bringing up the Ethereum chart.
Extremely bullish. Now this is terrible.
That is a broadening structure.
You cannot start a technical analysis in the middle of a chart.
Last time you complained I was interrupting you all the time.
Yeah, it's
now
not
you're doing the exact same to me. You wanted a technical assessment of the Ethereum chart, and I'm providing one. So at least let me do it. So that is a down leg. You've got a temporary support. You are leaning on that. It would be very aggressive to call that a bottom on a sell-off period like that. It could be. It's not the most high probability. This typical is downside continuation. Until you've run that high, I would say
Now,
you can't assume that until you get something like a W bottom. Let me draw it for you. The way you would fix this.
I mean, I'm okay. I'm okay. I have my charts also, and this is not the way I do my technical analysis. I can promise you, and I can tell you right now that the
Yeah, you
Ethereum
use
chart looks
indicators. I
extremely.
know what you do. That's
No,
where
but
we are different.
indicate. No, I don't. I do technical analysis on this one here. If you look at the 4-hour chart and you look at the 250% run up you had since April of this year, and then you give away 50% of that, that's not too uncommon. And now you actually have a very bullish setup. If you look at the divergences we have on the 4-hour, you'll see that this looks like it's something that can run high. But again, this is something we can revisit. We can revisit in 3 to 6 months, and you can see that Ethereum can run above 10,000 at that point.
I've seen nothing high probability in Bitcoin and Ethereum, and I have in Monero and Knight. Knight's already performed to target. It proves the case for selective on technical merit, utilizing our methodology. That's what's working for us, and we'll continue to do it.
All right, guys. I think I'll let Matt wrap up. I think it's been a good discussion, and maybe we can pick this up as well on a later stage on the TA part as well, to maybe compare also the way you do TA and you look at charts. That could also be interesting. But we need to round it off, and I'd love to give the last few minutes to Matt on that note.
Anymore, it's almost like having a partisan debate, and they're important debates. And to Henrik's point, we'll test these probabilities and these strategies and these techniques out. I'm not a technical setup guy. I don't look at them anymore in outside of this simple, boring market that I'm in. That doesn't mean I'm right or wrong. It's just, it's very important, I think, to know that there's different profiles of investing in this panel, and there are different profiles of audiences watching this. And so for those that are looking more at technical setups, whether they're pig wrestling or not in the DXY versus inflation deflation, or whether they're pig wrestling in technical setups for cryptos or Monero, Bitcoin, or Ethereum, those are important for people that look at those trades. If they're going long or short energy, if they're going long or short metals, they're going long or short the S&P. Very important discussions. I respect people who have strong opinions on them. Henrik has very strong opinions. I think they're valuable. The DXY could easily go to 110. I see the reasons for that. What's beautiful about not being an investor, that's my profile. That doesn't mean it's a profile of everyone listening, but there are many who are listening who have the same type of profile at over 1,000 clients that I have from 90 countries. It doesn't mean we're not interested in making alpha in the markets. I'm not looking for alpha long or short anymore in these markets, because I'm a very different profile. Doesn't mean I'm right or wrong on my profile. It's just where I'm at. There are many people, whether they're in the top 1% or the bottom 10%, who I think need to protect themselves from fiat debasement, the debasement trade, whatever you want to call it. I keep it simple. I look at gold as a numerator, and whether it's over the TLT, whether it's over Bitcoin, whether it's over the US Treasury, you can pick your poison, pick your asset class. For me, I stopped trading literally in 2000, and since 2025, in that 25 years, since 2000, I've been long precious metals. It's a simple, we talk about simplicity for my type of profile.
Can you just remove the mic from your, because
it's too loud?
Creating...
Is it too loud? I'm just trying to think simplicity for many of us who don't have the time, the skills to look at technical setups. And that's for the people listening who are in that camp. For those that are in the other camp, this debate will be very important to test out in the next 6 to 9 months. I absolutely agree. For others who are just trying to make sense of the complex, to keep it simple, stupid, think having gold and silver is a simple, stupid trade, but it's a simple, smart trade because it's outperformed the S&P in total return for 25 years. Its days are just beginning. That doesn't mean it's a secular straight line. I look at history from 250 AD, from 1789 France, from Weimar, from Yugoslavia in the 90s to post-1971 America. I keep it simple. The setup, it doesn't matter the daily price or the 50-day moving or the 200-day moving average for me and for many of our clients who are putting a great deal of money into precious metals, only because what we do see is a debasement of fiat money. We can compare the different currencies and the different charts and different bands. That matters if you're trading or setting up for other trades. Absolutely matters. For my type of profile and the type of clients we have, we can avoid this type of partisan debate or probability debates, not because they're not important, but because we're trying to keep it even more simple. And I am cynical about stablecoin. I am cynical about Bitcoin, about BLS, about COMEX, about the Fed speak, about just about anything that comes out of Brussels or DC or Tokyo or Kiev or any place else. That's what keeps it simple. And again, I'm just representing that part of the conversation that says keep it simple. Fiat money is an ice cube. It's a beautiful ice cube. Some of it's yuan, some of it's euro, some of it's Swiss francs, some of it's dollars, some of it's Australian Canadian dollar. They're all different and unique on a relative basis. We can look at which shirt is dirty or not, but they're all bad shirts. And fiat money is a melting ice cube. Precious metals are a better store of value. If you're in it for 10, 15, 20 years for generational wealth possession or preservation, that doesn't mean it's your only trade, but it should be an allocation. It's why even Morgan Stanley, for gosh sakes, has a 20% allocation. It's why Gunlek has a 25% allocation. It's why the BIS made it a tier 1 asset. It's why central banks are stacking. For those, just those that are watching or thinking about the simple out of the complex, who aren't going to be able to trade or have the profile to trade. Some do, some don't. Some don't want to speculate or make probability bets. And of course, even gold and silver will not go in a straight line. But what all of us agree, at least as of this calendar date and time, is that gold and silver are a wise investment. I think they're more than just a wise trade. I think it's more than just a technical setup. I think it's part of a macro historical trend. We are at the end of a credit cycle, which means at the end of a fiat money cycle. That does not mean gold or silver are the only trades. You can rotate in and out of one depending on the charts and the signals. I don't rotate in and out. I have an allocation to silver. I have an allocation to gold. I trust one thing. The central banks will screw it up in the long run. I'm not going to fight them, but they're destroying our currency right in front of us. It's a fat pitch for me, but I'm not a trader. And so I think these debates between Henrik and Francis are important for those that are looking at other anti-fiat solutions or crypto moves. I mean, look, of course, Bitcoin's outperformed everything. It had a 5,000% year so many years back. It's the best performing asset on an annualized basis than anything. That doesn't mean I trust it more than 20 that I can throw it. But again, that's just my view. But it's so simple for me. It's so simple, and I'm not meaning to be smug or axiomatic about it, but gold and silver are only in the first innings of a secular bull run because fiat money is in the very tail end of a long, slow death by 1,000 cut death. So again, does that mean I'm going to price predict silver for the next 6 to 9 months or gold for the next 6 to 9 months? I think it's the wrong question. If you're an investor and not a trader, if you're an investor and you're trying to maximize alpha on rotating in and out of silver and gold, I've never seen people do it well. I've seen a lot of people try. They all have case studies and examples where they got the trades right. The trade in gold and silver has been right for the last 25 years. Didn't mean silver was ripping for years. It's just starting to now. It doesn't mean gold beat the S&P every year, but it's outperformed over a quarter of a century because since 2000, the direction of paper money and fiat money and central bank despondency and desperation has been obvious. That to me is still very much the trade going forward as an investment. I shouldn't even say the trade. It's the allocation. Should it be 100%, 90%, 80%? Of course not. That's up to your profile, but it certainly should be an allocation. And I'll end, I say, I think at least as of today, for the next few years, I know Henrik thinks it's still a good time for a pullback, but I think we all agree that gold and silver are going to be good investments in this environment. And I don't want to go into another crypto debate now because we're out of time, but that's where I would end it. But I think it is important for Henrik and for Francis to talk about these trades. I think it's I got to give a lot of respect for Henrik and for Brent Johnson, who are being contrarian on the dollar trade more than most of us cynics. And I am a cynic, and I could be wrong, but I still think I'm going to be right on the gold and silver 10, 20 years from this conversation. 10 or 5 weeks from now, I don't know. But I think that would be a better conversation maybe when we're all a little bit even older and grayer. And again, I'm not saying gold and silver goes in a straight line, but I respect people who take an opinion, take a stance, and defend it. And I think when it comes to trading, one thing I know as a former trader, whether it was arbitraging cap spreads or bonds and equities and tranches, good traders can debate all day long. You can spend hours on it. And I think we'll just see what the tape tells us in 6 months, to Henrik's point, you know. But you got to respect someone who puts his neck out there and gives an opinion. And I do, both of them. So that's where I'll close.
Thank you, Matt. Thank you, gentlemen. Well, unfortunately, this we need to wrap it up.
Yeah.
Like a nice little Christmas gift that this was for our viewers and listeners. Thank you to each and one of you. I also want to wish really happy, blissful times for the Christmas time for not just you three, but everyone who's listening and viewing this. I think this is a beautiful moment of the year where we can also like step back a bit and enjoy the few things that we have in life that do actually matter, like family and friends. And look beyond the grim, cloudy, dark sky that is overshadowing the monetary landscape nowadays, if I may say. So any last not arguments or whatever, but just wishes that you might want to share, guys?
Well, the wealthiest things, the most important things, and the truest wealth is invisible. It has nothing to do with gold or silver or crypto. And I do think I agree with you on that. We're all mortal. We're not going to remember how much we made on a trade 20 years from now. We need to protect ourselves, but I think we're going to remember the few friends that we were able to keep, the people closest to us, and the connections we made. And I know that sounds Pollyannish, but that's always, to me, been the real wealth, and that's what guides me. But of course, we need some financial freedom to enjoy those moments too, so they're all important.
Yes, I'd say similar sentiments. Life, freedom. In fact, our primary agenda is not really, I'm not overly money-focused person. I just think it's an essential to establish your wealth, protect your wealth, and secure as much freedom so that you can have all that lifestyle that brings about those happy moments, family time, extramurals. We did some fun stuff in Cape Town when we were all together, and that's living. It's the life experiences that are shared with people of like-mindedness. And if on a signing off note, I wish everyone else a Merry Christmas from my side and my team. And for those that think we offer something, our YouTube channel is The Market Sniper. You can also follow us on X on The Market Sniper, and the same for the Crypto Sniper, where we do have an allocation, but we are predominantly sound money focused, but we recognize what's going down. So we, engage with us there. And thank you to the other guys for the discussion as usual. And I wish everyone a happy Christmas and a prosperous new year.
Yeah, so it's all about family and freedom, and yeah, I love these debates also. And even though it's get heated, it's always about understanding the other point of the other side, and then take it from there. So thank you very much, guys, and Merry Christmas to everybody.
Good stuff.
Thank you, gentlemen. See you next year.
All right.
See ya.
Cheers.